Hello and welcome to yet another lesson on consolidation, and we are doing consolidation of balance sheets. And in today's lesson we are looking at financial reporting past paper question on May 2021 question 5. May 2021 question 5. The question reads, on 1st April 2018, Ambaza Limited acquired the following investments. Ambaza Limited acquired the following investment. The first thing we need to note, just on reading the first point, is the date. On 1st April 2018. That will be important as we go along. The first investment, they acquired 1,320,000 shares in Rudisha. So Ambaza acquired Rudisha. We are not told the percentage, we are just given the number of shares, which is easy to get since we have the number of shares in Rudisha. So at a cost of 27,300,000, when the retained earnings of Rudisha Limited were 12.5 million. So that 12.5 million is the pre-acquisition retained earnings, and the cost of 27.3 million is the purchase consideration. Fine. They also acquired 50% of Rudisha's Limited 12% debentures at par. That's okay, but we will not be considering that when we are computing the goodwill, because that is not part of the net assets. That the debentures are not part of our net assets in Rudisha. That's okay. The statement of financial position for the two companies as at 31st March 2020. So the balance sheet we have is for 31st March 2020, and these two were acquired 2 years back on 1st April 2018. So we need to be a bit keen on those two dates. So this company was acquired 2 years ago. Rudisha was actually acquired 2 years ago. The statement, we are given the balance sheet for the two companies, Ambaza, which is the holding company, and Rudisha, which is the subsidiary. We also given additional information down there where we are told that the fair value of Rudisha's net assets at the date of acquisition was equal to their carrying value, except for an item of plant which had a fair value of 1.6 million in excess of its carrying value, and the plant had a remaining useful life of 4 years. So this is a revaluation, and we are told that when they examine the books of Rudisha, all the assets, all the net assets were equal, the fair values were equal to their carrying values, except for one item which had 1.6 million in excess. Now that one we are going to take it to the revaluation reserve, and we're also going to calculate the depreciation. We are also going to calculate the depreciation, and in this case, since the value was in excess, they were using a lower figure to compute the depreciation. They were using a lower figure to compute the depreciation. Now this means that we are going to have a depreciation undercharge in our assets. We are going to have a depreciation undercharge in our assets since the figure was in excess. Higher. Number 2, on 15th March 2020, Rudisha Limited sold goods to Ambaza for 700,000, all on credit terms. So that is intercompany sales, and also it gives rise to intercompany debts. The company had not the goods had not been received by the company as at 31st March 2020 and were not included in the closing inventory. No entry had been made in the books of Ambaza Limited in respect of this transaction. Rudisha Limited sells goods to all the customers at a standard markup of 16 2/3%. So again, that is giving us unrealized profit on closing stock. As at 31st March 2020, the accounts payable of Ambaza included 750,000 due to Rudisha before taking into account the above transaction. So again, yes, so that again reflects the intercompany debts we have between the two companies. Number 4, Ambaza Limited had not accounted for dividends receivables from Rudisha. That's okay. Goodwill arising on acquisition of Rudisha Limited was considered impaired by 20%. So that is impairment of goodwill as at 31st March 2020, and the fair value of NCI is 6.8 million. You are supposed to prepare a consolidated statement of financial position as at 31st March 2020. So let's go ahead and prepare that. So we have, this is a question on May 2021, question 5. May 2021, question 5. The first thing we are going to do, we are going to determine the percentage of ownership Ambaza has in Rudisha. So we are told on the very first statement that Ambaza Limited acquired Rudisha by purchasing 1,320,000 shares. 1,320,000 shares. Now we need to go to the balance sheet of Rudisha and determine how many shares they have. Need to go back to the balance sheet of Rudisha and determine how many shares they have. So if we go back to the balance sheet, we can see that they have 16,500 as the value, but the ordinary share capital's par value is 10 shillings. So we will take 16,500. They have a total value of 16,500 in shares. We divide by 10, this is giving us 1650. That is giving us 1650. So 1650 is the number of shares. So if we take 1320 divided by 1650 times 100, this is giving us 80%. So it means that Ambaza acquired 80% of Rudisha. That's okay. Now the next working we are going to do is the goodwill. We need to find out the goodwill, and we are told from additional information number 6, we are given that the fair value attributable to the NCI or the non-controlling interest amounted to 6.8 million. Now if we are given the fair value of NCI, then automatically we will use the full method in calculating goodwill. And to use the full method, we will take the purchase consideration plus the fair value of NCI, minus the net assets acquired. We take purchase consideration plus the fair value of NCI minus the net assets acquired. So we get the purchase consideration. The purchase consideration in this case, we are given in point number on the first paragraph. They acquired 1,320,000 equity shares in Rudisha Limited at a cost of 27.3 million. So 27,300. That is the purchase consideration. That is the cost they incurred to acquire these 1.32 shares, 1.32 million shares. Now we add the fair value of NCI, The fair value of NCI, we are given the fair value of NCI are 6.8 million. On point number 6, 6.8 million. So we get the total there. We have 27,300 plus 6,800. This is giving us 34,100,000. Now we less the net assets acquired. Net assets acquired, we less the net assets. So we start with the ordinary share capital. And in this case, the ordinary share capital we are given as 16.5. We also have the pre-acquisition retained earnings. We are given as on the first paragraph. They acquired 1320 equity shares in Rudisha Limited at a cost of 27,300,000 when the retained earnings of Rudisha were 12.5. So 12.5. And lastly, on point number 1, that item which had a carrying value in excess, we will create a revaluation reserve for that item. That item on point number 1, reserve of 1.6 million. So if we add 16.5 by 12.5 by 1.6, we will be getting let's go ahead and calculate that one. 16,500 plus 12,500 plus 1,600. That is giving me 30,600,000. 30,600,000. So 30,600,000 minus 34,100,000 is giving me 3,500 as the goodwill. Now we are told that on point number 5, goodwill arising on acquisition of Rudisha was impaired by 20% as at 31st March 2020. So we take 20%, the impairment, 20% of 3,500. This is giving me 20%. This is giving me 700. I less from there, I get 2,800 as my new goodwill after impairment. So those are the two major workings. The rest we can do them as we prepare the balance sheet. So in this case, we'll have Ambaza Group, the balance sheet now. Ambaza Group, consolidated statement of financial position. As at 31st March 2020. As at 31st March 2020. Now, we take our non-current assets. So we have our first item as PPE, and in our PPE we will be taking the holding company plus the subsidiary. So from our balance sheet we take the holding company, that is 7,300, plus the subsidiary 24,060. So plus the depreciation, the revaluation in excess, it was in excess, so we add 1600 and then we calculate the depreciation. So this revaluation was in excess, so we need to calculate the depreciation that they were charging on that revalued amount. So we will be taking the straight line, we will be using the straight line where we take the cost minus the scrap value divided by the useful life. In this case, the cost is 1600 divided by the useful life. We are given the useful life as 4 years. This is 1600 divided by 4 is 400. But now this company was acquired 2 years ago, so they have been providing depreciation for 2 years. So we multiply by 2. 400 times 2 will give us 800. So 800, we minus 800. We minus 800, there was provision of depreciation. So we get 37,300 plus 24,060 plus 1600 minus 800, giving me 62,160. We go to the next one, investments. So the investments, you can tell I have 52,600 plus 4,800 from the subsidiary. But now we are told that they acquired some investments. But even before we go there, this 52,600 plus 4,800, we are going to less the cost of acquiring the subsidiary, which is 27,300, because we have already used it in the computation of goodwill. We are going to less that, and also we are told that the company acquired 50% in the first paragraph, 50% of Rudisha's 12% debentures. So that is part of the investment. So we are going to reduce that by 50% of 2,800. We are told, we can see from our balance sheet, we have the 12% debentures were 2,800 in Rudisha. So half of that was acquired by the holding company. So half of 50% of 2,800, so that is 1,400. We less it from the investment. So the net investment, we are going to take 5,200 plus 4,800 minus 27,300 minus 1,400 is giving me 28,700. And then I have the goodwill. I had already calculated the goodwill. We calculated that goodwill as 2,800. From there we go to current assets. Current assets, we take inventories. And inventories we have the holding company 6,350 plus the subsidiary 5,200, and then we less the unrealized profit, which we need to calculate, and the goods in transit. So let's go ahead and calculate the unrealized profit. From point number 2, we are told that on 15th March 2020, Rudisha sold goods to Ambaza Limited for 700,000, all on credit terms. The goods had not been received by the company as at 31st March 2020 and were not included in the closing inventory. No entry had been made in the books of Ambaza in respect to these transactions, and Rudisha Limited sells goods or to all customers at a standard markup of 16 and 2/3. 16 and 2/3. So we need to do some working here, and we can do unrealized profit on closing stock. Unrealized profit on closing stock. Unrealized profit on closing stock. So the goods that were sold were worth, the goods that were sold were worth 700, and we are told the markup is 16 and 2/3, 16 and 2/3. So if I convert that one into a decimal, I'll have 16.667. If I convert it into a percentage, I'll get 16.667 divided over 100. Now this is a markup. I'll have to convert it into a margin because this is the selling price. This is the selling price, and you know that markup is based on cost, whereas the margin is based on the selling price. So we need to convert it into a margin, and converting it into a margin, we will have 16.667 over, we take the numerator, we add to the denominator, 116.667. that is our margin. Now we can multiply this by 700. If we multiply that by 700, I get 100. I get 100. So 100 is my unrealized profit on closing stock. My unrealized profit on closing stock. Now, since the goods were not received, I will take minus 100, and you also told minus 100, that is the unrealized profit, and you also told that no entry had been made in the books. No entry had been made in the books. So we need to make that entry by adding the 700. We need to make that entry by adding the 700. So that is the inventories. And if I add the 4 items, I'm getting 12,150. Next we have receivables. Receivables, I take the holding company for 360 plus 1950 minus the intercompany debt of 700 minus the intercompany debt of 700. We are also told on point number 3 that as at 31st March 2020, the account payable of Ambaza included 750 due to Rudisha. So that is also increasing our receivables, and to correct that, or to account for that, we less 750 to eliminate that intercompany debt. we minus 750 in both the receivables and the payables, so we less 750. So 4360 plus 1950 minus 700 minus 750, we get 4860. Next we have bank. I can see that we only have one item, which is 1390. Current assets are done. Now we go to the total assets. Get the total assets there. We'll add that one as we come to an end. So let's now look at equity and liabilities. So we have ordinary share capital. Ordinary. $43,000. We have retained earnings. So we can leave it blank. We have to do some working on that. Also have non-controlling interest. We can leave it blank as well. And then we do non-current liabilities. Non-current liabilities. So non-current liabilities, we have 12% debentures. Take the holding company, 8200, plus half, because the subsidiary, the holding company acquired half of the debentures in the subsidiary, as on the we can tell from the first paragraph. So we have half of that is 1400. If we add that, we get 9600. Next we have deferred tax. Deferred tax, we have deferred tax as 3900 plus 1200. That 900 is giving us 5100. 5100. We go to current liabilities. Current liabilities, get accounts payable. We take 5710 plus 1760 minus the intercompany debt of 750. So that one we get 6720. 6720. We also have taxation. Taxation, we take H plus S, 5330 plus 2410. We get a total of 7740. We have dividends. Dividends, we have 1300. And we also have 1200, yeah. But now this 1200, we are only going to recognize 20% of that. We'll only recognize 20% of that. So we'll have 20% of 1200, and this is because we are told on point number 4 that Ambaza Limited had not accounted for the dividends receivable from Rudisha. So we are only going to recognize the dividends attributable to the non-controlling interest, so which is 20% of 1200, because the rest of the dividends have not yet been accounted for. So that will give us 1300 plus 1540. It will give us 1540. Lastly, we have the bank overdraft. The bank overdraft, we have it as 1950. We have it as 1950. So lastly, we can do the workings for retained earnings and for the NCI. We can do the workings for the retained earnings and the NCI. Start with retained earnings. So we take the parents' retained earnings. The parents' retained earnings, we have it on the balance sheet as 34,560. Then we add the dividends receivable. They are not accounted for it, so we will take 80% of 1200. We have 960. Then we're going to take the investee or the subsidiaries share of post-acquisition retained earnings. Subsidiary share of post-acquisition retained earnings. So the post-acquisition retained earnings, we take the balance brought down from our balance sheet is given as 8190. The balance brought down is 8190. So we have the pre-acquisition retained earnings. We less the pre-acquisition. We less the pre-acquisition retained earnings of 12,500. We made a loss. 12,500, 8190 minus 12,500. It looks like we made a loss. So let me calculate. 8190 minus 12,500, 4310. This is our post-acquisition retained earnings. So the post-acquisition retained earnings, we need to do some adjustments, and the first one we're going to do is the depreciation overcharge.